There is a number circulating through the back offices of 3 central banks right now that almost no one outside the system has seen. It is not a price, it is not a forecast. It is a settlement figure, and the date attached to it sits less than 90 days from where we are standing. That number is not being discussed on CNBC. It is not in the morning newsletters. It is not in the analyst notes being passed around retail trading desks. It exists in a different layer of the conversation, the layer where the people who actually move capital communicate with each other through filings, through quiet meetings, through infrastructure announcements that look procedural on the surface but rewrite the rules of access underneath. Something shifted in the architecture of global settlement this month. The world missed the signal. And by the time the signal becomes a headline, the window to act on it will have already closed for most of the people watching.
Let me show you what I mean. Welcome back. I am the Calm Analyst, and on this channel, we do not chase candles. We read structure. We read paperwork. We read the silence between announcements, because in markets that silence is almost always where the real positioning happens. Today, we pull back the curtain on what just unfolded between the CME, the Federal Reserve, and a quiet cluster of institutional pilots that the major banks have been running for longer than most of you realize. 3 threads, 1 pattern. Let's jump in. Let's start with the hard truth. Roughly 95% of retail investors are watching the wrong screen. They are staring at a 4-hour candle chart and asking why the price hasn't moved. The honest answer, the one that nobody monetizing your attention wants to give you, is that price is the last thing to move in a cycle like this one. Not the first. The last.
To understand why, you need to understand a system that was deliberately built to be invisible to retail eyes. It's called institutional pre-positioning, and it operates through 3 mechanisms most people have never had explained to them properly. The first is regulated derivatives infrastructure. When the Chicago Mercantile Exchange lists a 24/7 futures contract on an asset, it is not creating a new way for retail to gamble. It is constructing a legally compliant doorway for capital pools that are prohibited by their own charters from touching spot crypto. Pension funds, insurance reserves, sovereign wealth allocations. These entities cannot legally buy XRP on Coinbase. They can hold a CME-listed derivative. That distinction is the entire game. The second mechanism is shadow accumulation through OTC desks. When BlackRock, Fidelity, or a sovereign entity wants to acquire a position, they do not place a market order. That would move the price against them. They route through over-the-counter desks that source liquidity from miners, from corporate treasuries, from existing institutional holders, and that volume never appears on the order books most retail traders watch. You are looking at the wake of the boat. The boat itself passed hours ago. The third mechanism is the regulatory clearance gate. This is the one being unlocked right now. Until an asset has explicit legal classification, regulated U.S. institutions cannot allocate to it without absorbing what compliance officers call headline risk. Once that classification arrives, through legislation, through court ruling, through a definitive agency statement, the gate opens, the risk premium evaporates, and the capital that has been waiting in the wings does not walk through that gate. It floods through it. XRP is sitting at the intersection of all 3 mechanisms right now. The CME has built the doorway. The OTC desks have been quietly working for months, and the regulatory gate is being pulled open in real time. The people who understand this are not surprised by what's coming. They are surprised it took this long. Let's do the math the retail crowd ignores. The global cross-border payments market processes approximately $150 trillion in annual volume. The daily foreign exchange market moves roughly $7.5 trillion. The derivatives market, the deepest pool of capital on the planet, sits at an estimated $1.2 quadrillion in notional value. These are not abstract numbers. They are the rails of global finance. And at this moment, those rails are inefficient, slow, and locked up in $27 trillion of nostro vostro accounts that exist solely to pre-fund settlements that should take seconds and currently take days. Now consider the supply side. XRP has a fixed cap of 100 billion tokens. Roughly 55 to 57 billion are in circulation. The rest sits in escrow, released at 1 billion per month. And historically, the overwhelming majority of each release is relocked. That is not a token with elastic supply. That is a token with a hard ceiling. Here is where the math becomes uncomfortable for the skeptics. If XRP captures even 0.5% of the cross-border payments market, not the derivatives market, not Forex, just cross-border, that is $750 billion in annual settlement volume flowing through a token supply that is shrinking on exchanges by the week. The velocity required to clear that volume at current prices is mathematically incompatible with current prices. The token has to revalue upward, not because of speculation, but because the system requires it to. Higher unit price means fewer tokens needed per transfer. Fewer tokens per transfer means lower slippage. Lower slippage means the system works. This isn't a prediction, it's a design requirement. If you have a problem with the numbers, you don't have a problem with me. You have a problem with the arithmetic of liquidity. The math doesn't lie. The system either prices the bridge asset correctly, or the bridge doesn't function. And the entities building the bridge, Ripple, the central banks piloting CBDC interoperability, the major card networks running stablecoin tests, are not building it to fail. While retail investors are scrolling Twitter and asking why the chart is flat, the institutional signal has never been louder. You just have to know where to listen. Ripple's acquisition activity over the past 18 months tells you everything. Hidden Road, a prime brokerage with multi-trillion-dollar annual clearing volume across traditional finance, was absorbed into the Ripple ecosystem. That is not a company you acquire to serve retail customers. That is a company you acquire because you intend to clear institutional flow at institutional scale. Standard Custody, Medico. The pattern is consistent. Ripple is not building a payments app. It is assembling the operational stack of a regulated financial institution that happens to settle on the XRP ledger. Look at the central bank layer. The Bank of Japan has been openly discussing settlement modernization in language that overlaps almost word for word with the use case XRP was engineered for. The IMF's recent papers on cross-border CBDC interoperability describe, without naming it, exactly the kind of neutral bridge asset that the XRP ledger was designed to provide. Larry Fink has stated publicly that the tokenization of every asset is the next generation of markets. Jerome Powell has acknowledged that the existing settlement infrastructure is overdue for replacement. Ask yourself this brutal question. Does a trillion-dollar firm like BlackRock move without absolute legal certainty? Does Fidelity allocate engineering resources to a tokenization stack without knowing exactly where the regulatory perimeter is going to land? These entities do not gamble. They do not chase narratives. They position, quietly, methodically, and years before the rest of the market catches the scent. This is not retail FOMO. This is calculated infrastructure assembly by custodians who already know what the next phase of the financial system looks like, because in many cases, they're the ones building it. The catalysts are no longer theoretical. They have dates attached. The CME's 24/7 futures contracts come online this quarter, the procedural launch that hands institutional capital a compliant, around-the-clock instrument for XRP exposure. That is not a small step. That is the bridge between regulated institutional balance sheets and the XRP market being completed in concrete. The Digital Asset Clarity Act continues advancing through the U.S. legislative pipeline. Each procedural step removes a layer of classification ambiguity, and each removal opens an additional class of institutional allocator who was previously waiting on the sidelines. When that final legislative clarity arrives, the headline risk that has kept compliance officers cautious for years evaporates in a single afternoon. The wait-and-see capital becomes all-in capital. Beneath both of these, the macro environment is shifting. The Federal Reserve has signaled the beginning of a sustained liquidity expansion. The European Central Bank is moving in parallel. The People's Bank of China is operating in the same direction. When the three largest monetary authorities on the planet expand their balance sheets simultaneously, capital seeks yield, seeks asymmetry, and historically, over the past 2 cycles, has found its way into the digital asset class with a lag of roughly 3 months from the start of expansion to the start of repricing. The fuse is lit. The countdown has begun. And the people who understand the lag are not watching daily charts. They are watching the calendar. We are moving from an era of abundance to an era of scarcity. And most people watching this asset have not yet processed what that actually means. Exchange reserves of XRP are sitting at multi-year lows. The tokens are not being sold, they are being moved. Off exchanges, into cold storage, into multi-signature institutional vaults. And once a token enters one of those vaults, it does not come back to the market for a 10% gain. It does not come back for a 50% gain. It comes back when the strategic mandate that put it there is complete, which could be years. This is the supply drain that retail does not see, because retail watches order books and not custody addresses. The float, the actually tradable supply, is contracting in real time, and when the regulatory gate opens and the institutional bid arrives at full strength, that bid will be hitting a market with materially less available supply than it had 18 months ago. The arithmetic of that collision is straightforward. More demand, less supply. A price discovery process that does not move in straight lines, but in gaps. Once the final switch is flipped, the retail entry point you see today will not exist. The conversation will shift from accumulating whole tokens to accumulating fractions. From asking what the price is to asking how much exposure you can still afford. The door is closing, not all at once, but a little more each month. And the institutions that have spent years quietly absorbing supply did not do it by accident. They did it because they understood the door before the door was visible. I know it is hard to watch a chart that refuses to reward your patience. I know the headlines have been designed, and I use that word deliberately, to test the resolve of anyone holding through this cycle. The red days, the sideways months, the analyst takedowns, the recycled fear about regulatory risk that was resolved years ago. All of it serves a function. All of it shakes loose the holders who were never going to make it to the other side. But this is what training as an analyst teaches you. You learn to separate noise from signal. You learn that the loudest part of the market is almost always the least informed part. And you learn that being early feels precisely like being wrong, right up until the moment reality arrives and reorders everyone's understanding of what was actually happening the whole time. The boredom you are feeling is not failure. It is the texture of the accumulation phase. The silence is not absence. It is the silence of a predator waiting to strike. The institutions did not need you to sell, but they also will not refuse the liquidity if you do. That choice is yours, and it is the only choice that actually matters. The question is not whether the thesis plays out. The structure of the thesis is already visible to anyone willing to look. The question is who will still be holding when the floor under this asset becomes the ceiling of what retail can afford to enter. Price is a distraction. Structure is the reality. One is what you see on a screen. The other is what is being built behind the screen, in filings, in custody agreements, in legislation, in the quiet operational tests being run by the largest financial institutions on the planet. The people who understand the difference between those two layers will look back on this period the way an earlier generation looks back on the first listings of internet infrastructure companies, not as a moment of obvious opportunity, but as the moment when the obvious was only obvious to those who had done the reading. You are doing the reading. That alone places you in a category that the data tells us is exceedingly small. If this analysis sharpened your view of what is actually unfolding, leave the word structure in the comments. I want to see who is still here at the end and who is watching the signal instead of the noise. Subscribe if you want the next briefing the moment it lands. And share this with the one person in your circle who still thinks this story is about a chart. Stay patient. Stay rational. We do not wait for the future on this channel. We read the paperwork that builds it.